Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CONAGRA Brands INC quarterly report. CONAGRA Brands Inc. offers a diverse range of businesses and services through its four main segments: grocery and snacks, refrigerated and frozen, international, and food service. The company's products include shelf-stable food items, temperature-controlled foods, international food offerings, and customized culinary products for restaurants. The list of businesses and services provided by CONAGRA Brands includes shelf-stable food products, temperature-controlled food products, refrigerated and frozen, customized food products for restaurants and other food service establishments, meals, entrees, sauces, and custom-manufactured culinary products, food products in various temperature states for international markets. The company sells its products under several well-known brands, including Bird's Eye, Marie Callender's, Duncan Hines, Healthy Choice, Slim Jim, Reddi-wip, Angie's, and BOMCHICKAPOP. CONAGRA Brands Inc.'s stock price has significantly dropped by over -32.63% in the past year due to several factors. The company's weak guidance for fiscal year 2025, citing a difficult consumer environment, contributed to its decline. Additionally, underwhelming full-year guidance and inflationary pressures led to further drops in the stock price. CONAGRA's fiscal Q4 earnings missed Wall Street estimates, with adjusted EPS of 56 cents missing analyst expectations of 58 cents. The company's outlook for fiscal 2026 was also weak, with expected adjusted EPS ranging from $1.70 to $1.85, significantly below analyst estimates. The final blow came in December 2025, when CONAGRA reported weak fourth-quarter results, including a significant drop in sales and a swing to a net loss. The company's net sales decreased by 6.8% to $2.98 billion, primarily driven by a 3% decline in volume. These factors combined have led to the stock price drop of over -32.63% in the past year. The primary drivers of revenue growth or decline can be summarized into three main categories. On the one hand, revenue decline is primarily driven by a decrease in net sales, lower market multiples, weakened consumer sentiment, and downward revisions to projected sales and profit margins for certain reporting units. Additionally, input cost inflation, reduction in assumed royalty rates, and commodity contracts have also contributed to the decline. On the other hand, revenue growth can be attributed to an increase in net sales for the grocery and snacks segment, revenue growth in international and food service segments, and productivity improvements. The frozen segment has seen a significant increase in revenue, with a 17.1% growth in 13 weeks and 16.6% growth in 26 weeks. Overall, these factors highlight the complexities of revenue growth or decline, which can be influenced by various internal and external factors. Net income and profit margins have undergone significant changes over the past year. Net income decreased by $1.58 per diluted share, plummeting from a positive $0.59 in Q4 2025 to a negative $1.39 in Q4 2026. The net income also saw a substantial decline from $284.5 million in Q3 2024 to -$663.6 million in Q3 2025. Profit margins have also been affected, with gross profit margin decreasing from 26.6% in Q3 2024 to 23.4% in Q3 2025. Operating profit margin saw a more drastic change, increasing from 12.7% in Q3 2024 to -20.1% in Q3 2025. The primary reasons for these changes include an increase in asset impairment charges and loss on divestitures. Additionally, input cost inflation, unfavorable operating leverage, reduction in profit from divested businesses, lower interest costs due to debt reduction, and lower commodity trading revenue from equity method investment earnings have all contributed to the decline in net income and profit margins. The company's financial performance reveals a significant milestone. It is now generating positive operating cash flow. This achievement is evident in the net cash flows from operating activities for the year 2025, which stands at $331.2 million. This indicates that the company has successfully transitioned to a position where its earnings are sufficient to cover operational expenses and generate excess funds. The company's debt level and interest expenses have undergone significant changes over the past year. Notably, total liabilities decreased by $551.7 million, indicating a reduction in debt. Furthermore, net interest expense has also decreased, from $108.2 million to $96 million, and even more so in Q2 2026 and HON 2026, with a decrease of $12.2 million and $24.2 million respectively. The company's repayment of long-term debt has been substantial, with repayments totaling $1.02 billion in 2026 compared to $270.2 million in 2025. Additionally, the issuance of senior unsecured notes worth $1 billion in the second quarter of fiscal 2026 is expected to have a positive impact on interest expenses. Overall, these changes suggest that the company has made significant efforts to reduce its debt and lower its interest expenses, indicating a more stable financial position. Regional performance review. Our recent financial analysis reveals a mixed performance across various segments and regions. The international, food service, and refrigerated and frozen segments struggled to meet expectations, with the former two experiencing significant losses. In contrast, the grocery and snacks segment stood out as the top performer, achieving an impressive operating profit of $231.2 million. The poor showing from international and food service segments is a cause for concern, while refrigerated and frozen's relatively low performance suggests room for improvement. Conversely, grocery and snacks' exceptional results demonstrate its resilience in a competitive market. Management's outlook on company strategy. The company's management is focused on adapting to changing consumer preferences, with its portfolio expected to evolve accordingly. Despite anticipated negative impacts from inflation, tariffs, and weak consumer sentiment, the company will assess the macroeconomic environment and take proactive measures to mitigate these effects. To maintain financial stability, management aims to preserve investment-grade senior long-term debt ratings and ensure sufficient liquidity to manage long-term debt at maturity. The company is also investing in its future with estimated capital expenditures of $450 million for fiscal 2026. Additionally, management is rebuilding inventory levels and making significant repayments on long-term debt, demonstrating a commitment to financial prudence and strategic growth. Acquisitions and divestitures overview. CONAGRA Brands has made several strategic acquisitions and divestitures to enhance its portfolio and optimize operations. Acquisitions. The company acquired Pinnacle Foods, Inc., Sweetwood Smoke & Co., and a contract manufacturer in 2024. Additionally, CONAGRA purchased an existing contract manufacturer for $230.6 million. These acquisitions aim to expand the company's product offerings and manufacturing capabilities. Divestitures. CONAGRA has divested several businesses, including its ownership stake in Agro Tech Foods Limited, which was sold for $76.8 million. The company also sold its Chef Boyardee business and frozen fish business for a total of $648.9 million. These divestitures are part of the company's efforts to streamline operations and focus on core businesses. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $334.8 million in 2025, with a quarterly cash dividend of $0.35 per share issued on November 26, 2025. Additionally, the company has also engaged in share buybacks, repurchasing 0.8 million shares for an aggregate of $15.3 million in the first quarter of fiscal 2026. Concerns about inventory buildup and supply chain disruption exist. The company's financial summary reveals concerns regarding inventory buildup and supply chain disruption. Notably, total inventories increased by $151.5 million from May to November 2025, indicating a significant accumulation of stock. Furthermore, the supply chain has faced pressures, leading to a decrease in organic volume in the grocery and snacks segment due to changes in retailer inventory. Additionally, temporary manufacturing disruptions in the Hebrew national business impacted net sales by approximately $24 million. These issues highlight potential risks for the company's operations and profitability, underscoring the need for careful management of inventory levels and supply chain resilience. That concludes the financial summary for CONAGRA Brands Inc. Feel free to comment below, and I will be happy to answer them when possible.